Good afternoon and welcome to Conway Conversations, an insider's look at all things real estate. My name is Gillian, Marketing Director at Jack Conway, and I will be monitoring the Q&A for your questions as our CEO, Carol Bulman, and two experts take a deep dive into securing a loan as someone self-employed. So to start the conversation, let me introduce Carol Bulman.
And thank you for setting the stage for our very first Conway Conversations. We're really excited about this evening's event. As Gillian says, Jack Conway Company is an independently owned company. My father, Jack Conway, founded our company back in 1956. It's my distinct honor to bring this company into the second generation, and I'm fortunate that my children, my husband's and my children, are here to bring our company into the third generation. We have 25 sales officers throughout Eastern Massachusetts, just under 700 sales agents to service your both residential and commercial needs. We offer mortgage financing through Conway Financial Services, which you'll hear more about this evening. We also offer closing and title services through our title company, Columbia Title, and we offer insurance solutions through Conway Country Insurance. We are a true one-stop shop. We believe in providing all the necessary information for a buyer and a seller to make the journey through purchasing a home. In some cases, it's the largest investment anyone will make. What we can all agree upon, it can be wrought with confusion, a lot of details, and that's where we come in to help smooth out those edges, help you provide lots of information and options as you make your journey to closing on the property. So tonight we're going to be taking a deep dive into a topic specifically for our self-employed borrowers, our self-employed buyers. Conway Conversations is going to be dedicated to topics such as that. We're going to be holding this monthly. And each topic will be very specific about a certain segment of our buyer and seller interest that can be a little more complicated, that people tend to need some additional information about. So we chose self-employed as our first one because with the pandemic, this has provided some challenge for some of our customers who own businesses. If you think about our business owners in our community, they are the folks that keep all the engines running all around us. They are our hairdressers, our plumbers, our electricians. They are our gig workers. They drive our Ubers. They are our consultants. They are our accountants and lawyers. These are the folks that, although they provide us incredible services, sometimes they're faced with challenges when it comes to purchasing a home. So tonight we are going to be covering a very important topic, which is the self-employed buyer. And in tonight's case, it's the self-employed borrower. It's the person looking to finance the purchase of a home. And we'll be talking about the different types of options that are available for a self-employed borrower with one of our experts, two of our experts here at Jack Conway. And I'd like to introduce them now. So first, let me introduce to you David Michael. David is a realtor in our Lakeville office, one of our 25 sales offices. David's been with us about 7 years, and he has really made famous the commuter open house, offering snacks and beer and wine for your customers, David. So tell us a little bit about that and welcome.
Hi, thank you, Carol. Yes, it's always great to ply buyers with wine right before they write up an offer. But all kidding aside, I'm thrilled to be here, and I am a full-time realtor specializing in the southeastern Massachusetts market, and I can also help anyone anywhere globally.
Excellent. Thanks, David. I appreciate taking the time to be here tonight. And our second expert is Kevin Richardson. Hi, Kevin. Kevin's the president of Conway Financial Services. Kevin's worked with us for 11 years, but he's been in the business for a long time. So not only does he lead our expert group of loan officers here servicing the buyers at Jack Conway and beyond, but he also juggles a very large family, including 5 children. So Kevin, welcome.
Thanks, Carol. Excited to be here tonight. I do have 5 wonderful children, but 4 of them are done with college, so I'm close to surviving this thing.
Excellent. That's good. So Kevin is going to provide us quite a bit of information about how you, or maybe if you have a customer, this is a self-employed person, our audience is made up of people in what I would call the real estate community. So they are our buyers, our sellers, our realtors, also just members of the community that may want more information about this. So we're going to jump into this topic. But Kevin, before we do that, I'd like to talk a little bit about the foundation, meaning you've got self-employed borrowers, but you also have your regular W-2 employee. There is this elusive 2 names that we hear all the time, Fannie Mae and Freddie Mac. Tell us a little bit about who they are, what is the role they play, and why is it important that our listeners understand this?
Sure. Thanks, Carol. That's a good way to start. So when you hear of traditional or financing, a lot of times you'll also hear the word conventional financing. And when you hear conventional, what that's referring to is that the loan is going to be insured through Fannie Mae or Freddie Mac. And people always ask, well, you know, who is Fannie Mae? Do I get my mortgage through Fannie Mae or Freddie Mac? And the answer to that question is no. What Fannie Mae and Freddie Mac are, they're government-sponsored entities. So they were created by the United States Congress. Fannie Mae has been around since 1938. Freddie Mac was introduced in 1970. So both have been around for 50 plus years. They're overseen by what's called the Federal Housing Finance Agency. So as I talked about, you don't get a loan through Fannie Mae or Freddie Mac. Neither of them originates or services their own mortgages. Instead, what they do is they buy and guarantee mortgages issued through lenders in what's called the secondary mortgage market. And really what they're doing is they're performing probably the most vital role in our nation's housing finance system. They're providing liquidity, stability, and affordability to our mortgage market. In addition, Carol, just so you know, and we always talk about Fannie Mae and Freddie Mac, there are other terms you'll hear such as FHA, USDA, VA mortgages, all so-called traditional mortgage products.
Thank you. And thanks for touching upon the other mortgage products as well, because I think what's critical here is these entities can all be accessed by going to either a mortgage company like Conway Financial Services or a bank. Is that correct, Kevin?
That is absolutely correct. Yes. You can you can't call Fannie Mae looking for a mortgage.
Okay. All right. There's no 1-800 Fannie Mae. Okay. Got it. All right. So we've established the foundation. We know what's behind the curtain, if you will. To access the curtain and the rules, you need to find a loan officer that you know, like, and trust. We certainly have them here at Conway Financial Services, and Kevin is one of them. So Kevin, let's talk a little bit about the rules. We know they make the rules. What are the 3 main areas that these lenders or these institutions look at when they make a decision on whether a person can afford a home?
Sure. So for any of you that have gotten a mortgage before, you're asked to provide a lot of information. If you haven't been through a mortgage, we do ask for a lot of information. We do not ask you to give blood. That's only a rumor. But it really comes down to there's 3 main parts of getting pre-approved. The first part is your credit score. So what every lender will do is they're going to pull a copy of your credit report. They're going to get a score from each of the 3 credit bureaus, and they're going to use the middle of your 3 scores as what's called the qualifying score. The second thing would be the down payment. So depending on how much or how little you're looking to put down, there's different mortgage products available for that. The third thing, and that's what's tricky with self-employed people, are what's called the ratios. We're going to ask for employment and, more importantly, income information. And there's 2 ratios, a housing ratio and what's called a total debt to income ratio. And I can just quickly tell you that we're going to try to figure out your income on a monthly before tax basis. So lenders use what's called gross monthly income. That housing ratio takes what a payment's going to be, principal, interest, taxes, and insurances, divides it by that total income. That gives you the housing ratio. And then for that total debt ratio, we take that housing payment, and to it, we add the minimum payment of debt from credit report. Divide that by the income. That's that total debt ratio that we're talking about.
Okay, so the goal there is your job is determine whether a person has enough income to be able to reasonably cover the expenses involved in a mortgage, as well as the debt that they're already covering. That's where the ratios come in. Is that correct?
Absolutely.
Okay, so let's shift a little bit to the self-employed individual. You had mentioned when you talked about the three main areas that, say, Freddie Mac and Fannie Mae look at. You mentioned the ratios and income. So a self-employed person utilizes not a W-2 to show their income. They use tax returns. Is that correct?
Correct. It would be tax returns.
All right. So tell us a little bit about the biggest obstacle that you see for the self-employed individual in borrowing money to purchase a home.
So it would absolutely be that employment income piece. The joke that I like to make is a lot of self-employed people, in case you didn't know this, they don't actually claim as much as they actually make on their taxes. And lenders are going to use tax returns. For many people, that tax returns, it's not a true reflection of their income.
And a lender's concern is the paying back of the mortgage. They want to make sure that a person has enough income to be able to pay that payment. Is that correct?
That's correct. Yes. So they're going to determine the income and then look at those ratios to see if those ratios are in line with Fannie Mae, Freddie Mac guidelines to see whether they can approve that loan or not.
Okay. All right. So the traditional way of determining that is looking, as you said, the tax returns.
But yeah, a good point to make is for those of you that have had mortgages well in the past, there's no such thing as, stated income loans or no income type of loans. We have to verify some income.
And that's actually good news, isn't it?
It is. I think so. I think it's great news.
You and I lived through a very difficult time when there was a lot of lending out there where people could basically just write down whatever they were making and get a loan. And we don't want to set our clients up for a situation that they can't afford. That's not something we want to do. And in the cases that we're going to be talking about tonight, it's a way of verification of income. It's a different methodology. It doesn't mean the income is not there. Is that?
That's very well said.
Okay. All right. So Kevin, tonight we're going to be talking about two ways for a self-employed person to purchase a home using financing. Okay. Obviously they could pay cash, but if they cannot pay in cash, they need to borrow money. There's two ways of doing that. Everything you've talked about up until now sort of falls into a bucket, what we call traditional lending for self-employed. Could you give us a little bit more detail on traditional before we get into a second option?
Sure. So again, when we talk about traditional, we're talking conventional loans through Fannie Mae or Freddie Mac. We're talking an FHA mortgage, a USDA mortgage, or a VA mortgage. So with that traditional financing, all lenders generally are going to require a 2-year history of the borrower's prior earnings. And they're going to use that as the means of demonstrating the likelihood that the income will continue to be received. So what that means is, one, the borrower has to be self-employed for a minimum of 2 years. And secondly, the 2 years of income will generally be averaged to determine the monthly income that can be used to qualify. And it's important to note that it's 2 years will be average, provided that the most recent tax returns show more income than the previous year. Okay, if that tax return, it's a good, I knew you were going to ask a question. I saw you light up a little bit.
Because if our audience is paying attention, and this is tricky because you could be walking your dog, you could be feeding your kids, you could be driving your car. But I want to pause for a moment and make sure you caught what Kevin just said. So if you are a self-employed person, let's say you're a restaurant owner, and you provide through traditional means documentation to show your income, you're using tax returns, right? If your most recent year is less than the year before, that raises a bit of a red flag, right? And our lenders will look at that most recent year. Did I get that right?
That is absolutely correct.
Okay, so don't worry, hang in there, because we have some other solutions that have not only might work for you, but have really worked for some of our customers, which is pretty exciting. Okay, before we get into that next option, Kevin, can you talk to us a little bit about documentation? Again, we're still on the traditional format of financing. for self?
Sure. So what lenders are going to ask borrowers to provide is copies of their federal tax returns, both their individual returns and in some cases their business return that were filed with the IRS for the past 2 years, as I mentioned. And they're also going to ask for all applicable schedules attached. So if the business is through a Schedule C, they're going to ask for all those schedules to see deductions and things like that. In addition to providing tax returns, depending on the time of the year, the borrower will also be required to provide a year-to-date profit and loss statement.
Okay, big mouthful of information there, right? Don't forget, everybody that's listening, you will get all this information when you apply for your mortgage in writing, and your loan officer, such as Kevin, will walk you through this. But I want to pause there because, Kevin, it's my understanding that here's a nuance between Fannie Mae and Freddie Mac when it comes to looking at a self-employed person. Is that correct?
There is, yeah. So we use Fannie Mae and Freddie Mac pretty much interchangeable. They're very much the exact same. One of the main differences is how they treat self-employed people. Fannie Mae is always going to require that those 2 years tax returns. Freddie Mac, on the other hand, if the borrower is employed for at least 5 years, if they're self-employed for at least 5 years, they're typically only going to require 1 year of personal or business tax returns. So in the situation where the most recent year shows a lot more income than the previous, if we can just show that 1 year, we're going to give credit for more income.
Okay, again, I want to pause on that point. That was a super important point. Why is that important? If a person, I gave you the example of a restaurant owner who made less last year than the year before. All right, now I'm going to give you a different example. Let's say you're in home construction. You made more last year than you might have the year before. In Kevin's example with Freddie Mac, you're going to be looking at just the most recent year rather than averaging 2 years. Did I hear that correctly?
That is correct in most cases, yes.
All right, good. So the other thing I want to leave you with before Kevin starts to talk about our second option. Kevin, everything that you're talking about right now, a person does not have to memorize all this, right? Where do they go for this information? Who helps them through the process?
We're actually going to have a quiz at the end of this, so we'll see who paid attention. But realistically, no, it's our job, my team's job, to provide that information. So, my team and many other lenders out there have years of experience. It's our job to weed through each individual borrower to find the right product and explain the differences for any of our customers. We do that through, gathering information, face-to-face meetings, phone calls, Zoom meetings such as this. But we're always available to kind of weed through the different options and see what would work best.
That's great. I think that's a really important point. You hear the terminology trusted advisor, and your loan officer is one of your trusted advisors, as well as your realtor. And we're going to be talking to David in a moment, but these two will work in tandem, your realtor and your loan officer as your trusted advisor, again, shepherding your way through the process, making sure that everybody's communicating, all the information that needs to be shared is being shared to have a successful closing. We all have the same goal, right?
It's a great point, Carol. I actually like to joke with people that, in many ways, we know more about that borrower than even their siblings or parents do. We know their credit score. We know their exact income information. We know how much money they have in the bank. So we do want to be that trusted advisor for them.
Excellent. And, actually, this is something that I thought of just as you said that. What's also important to know, oftentimes your realtor will refer you to a loan officer. So in our case, David would refer Kevin or Trisha, I think is his actual loan officer in his office. But the loan officer would not share confidential information back to the realtor. Is that correct?
100% correct.
All right, that's important. Okay, so now moving on to our new product, and this is really the reason for our event tonight, because I'm really super excited about this. This is something that Conway Financial has been offering for several months, and we were trying to come up with a way to get this information out to our customers, and this is one way we thought we could do this. And so I do really appreciate you signing in tonight, because I think you're really going to love to hear about this program. It's called Smart Self. And this is our second option for our self-employed individual. Kevin, could you walk us through this program?
Absolutely. So Smart Self is a great product. It's only available for self-employed. And when we say self-employed, 1099 employees also are considered self-employed. So it's people that own a business, own a percentage of a business, or file their taxes as a 1099 employee. So really what this program is designed for, it's designed for borrowers who do not show enough income on their tax returns to qualify. Whether that 2-year average makes it too much income, they show a loss on their business, but their business has been growing for the previous year. So with Smart Self, the borrower is not required to provide tax returns or a profit and loss statement. Ideally, we don't want to see, I can see the tax returns, but we don't want to submit them into underwriting basically. So what it does is it allows the self-employed or those 1099 employees to use either 12 or 24 months of personal or business bank statements to support their income in qualifying for a mortgage. So what we do is try to keep this as simple as possible. We look at the average amount being deposited into those accounts over that 12 or 24-month period, and we're going to average it to a monthly basis. The average is then reduced down by an expense factor, which I can talk about in a little bit. And then ultimately what we're going to do is we're going to multiply it by the percentage of the ownership interest in the business.
Okay, so to dumb it down for me for a minute.
Yep.
Tax returns are out, bank statements are in.
Correct.
All right, good. So that's what you're going to mainly focus on, or what you are going to focus on when it comes to looking at the income aspect of the self-employed individual. All right, what if, Kevin, a person doesn't own the entire business? Maybe they have partners?
So that's a great question. So I'll just give you a quick little scenario. If I got someone's bank statements, they have business returns, everything funnels through a business bank statement. Over the previous 12 months, they averaged $20,000 a month into that account. Okay, so we're starting out with a base of $20,000. We're going to take an expense factor. In many cases, it's only 50%. I reduced that amount down by 50%. We're down to $10,000 a month of what we're going to use as income. If the borrower owns 100% of the business, we're going to give them credit for that $10,000 a month. To answer your question, if they have a partner and they own 50% of the business, we're then going to take 50%. And in that case, we'd give them credit for the $5,000 a month.
All right, that's great. So there's a logic to this, and your loan officer will help you through this. There's a question just showed up in the chat, which I think is really timely right now, Kevin. The question is, my husband is a self-employed consultant, and I'm a technician for South Shore Hospital. Can both of our income be considered for this new program? So in other words, what she's saying here is he's self-employed, she's not. How do we handle that?
That's a great question. So I said in the beginning that the borrower has to be self-employed. Only at least one borrower has to be self-employed. So the answer to that question is yes. One of the benefits of the Smart Self loan is that you can combine income types. So one borrower must be self-employed, and we're going to use the bank statements to qualify. The other borrower can be a traditional W-2 salary-based, hourly-based employee, and we're going to get their W-2s and their pay stubs to qualify.
Awesome. Okay, that's great. Thanks, Kevin. I think that probably clarified a lot of people's questions out there. There's another one that I think is really important at this point to look at, and I think this is a really good question. Do I have to have good credit for this program?
Well, getting back to that, the short answer is no, but getting back to the three important things, the higher your credit score, the more options you have. This particular program, Smart Self, is pretty forgiving on credit scores. It will go down to as low as a 660 credit score, which is lower than some other programs out there.
That's interesting. So we've looked ahead to plan our future Conway conversations, and we actually have a program planned for after New Year's. And it's going to be about our credit enhancement program. We thought that was timely given it's after the holidays. So Kevin, tell us a little bit about just a thumbnail about credit enhancement.
Sure. Real quickly, what we do is we work with people all the time, and we don't want them to pay a credit counseling agency. What we can do is if we pull someone's credit and their score is too low to qualify for a program, or their score is their lower score is going to impact their rate. In some cases, what we'll do is we'll send their report to our credit enhancement team. credit enhancement will send back some specific, typically it's pay down accounts, but some specific instructions on what it would do to get that borrower's score up to a certain point. Borrower can make those payments online, get us an updated statement, we'll submit it back, and typically within less than a week, we're going to have a new score. So what we're doing is we're speeding up the process of them improving their credit.
All right, I think that's awesome. First of all, I think that's a great service. It's a free service, is my understanding. Is that correct, Kevin?
That is correct, yes.
All right, I've got another question here. This question is that, do you ever use a FICO score? Can you tell us what FICO is?
Absolutely. So a FICO score is a credit scoring model that all mortgage companies use. It's different from Credit Karma. It's a different scoring model. So lenders will pull a copy of a credit report. We're getting FICO scores. Highest score you can have is 850 on a FICO score.
Okay. All right, good. I just want to make sure we don't have any other questions there right now. Okay, excellent. Great questions. Thank you. Keep them coming. At this point, Kevin, there's been a lot of information shared. What I'd like to do is ask Gillian to pull up a slide that you created that shows us the comparison of the two ways of financing for self-employed. Remember, everybody, it's traditional on one end, and the other option is our new program called Smart Self. Kevin, can you walk us through the differences?
Absolutely. So just really quickly, on the left-hand side, we have its traditional financing. So that covers the conventional loan with Fannie Freddie, FHA, VA, USDA loans. Borrower is going to be asked to provide 1 to 2 year tax returns, individual as well as business. They're going to provide a year-to-date profit and loss statement, and we're ultimately going to use that net income averaged over the 1 or 2 years to determine the qualifying income. So we're not looking at their gross receipts. We're ultimately looking at after deductions at their net income and averaging that out. Look on the right-hand side, as I mentioned with our new Smart Self product, we're not getting tax returns. So tax returns are not required. We're going to get 12 or 24 months of bank statements where business income is being deposited into. We're going to average it over those periods. And just quickly, it's 12 or 24 months. We don't want to see it declining significantly, but if the business has been showing strong income for 24 months, sometimes the rate's a little bit better for over 24 months. In most cases, borrowers provide the 12 consecutive months, and that's usually what they use. As I mentioned, that average income over the 12 or 24 months is reduced down by an expense factor and then multiplied by that percentage of business owned. Very simple qualification. A question always comes up with me. Somebody's probably thinking it. How do I know which way to go? You could meet with a loan consultant. We could look at tax returns and see, could you qualify for what you're looking to do? If the answer is for no, we could have the borrower provide 12 or 24 months in advance of finding a property. We can submit them into our underwriting team, and we can get the income calculated before the borrower even starts to look. So that borrower knows right off the bat, yeah, I have complicated tax returns, but by using the bank statements, the lender's giving me credit for X amount. So it eliminates a lot of the worry, the risk, can I do it? It also allows us to provide a pre-approval letter and let people know that income has already been qualified.
Okay, that's awesome. By the way, you will all receive this slide from Gillian after the meeting, after this presentation. So don't feel that you have to take notes. Kevin, there's another question here from the chat. Is CFS, Conway Financial Services, the only lender who offers this program?
So it's a great question. There are other lenders throughout the country that offer it. I don't know many that are offering it in Massachusetts currently. I know some of lenders that offer it have kind of gone out of business in the last couple months, but they are available. There's not a lot of lenders. If you go for a typical mortgage that's insured by Fannie or Freddie, there's many, many options. With the Smart Self loan, there's limited options.
Okay, all right, great. And that was really our incentive to getting out to talk to all of you tonight, because it is kind of a cool little program that a lot of people don't offer and don't know about. So, we are in the business of helping people realizing their dream of home ownership. Okay, that may sound a little corny, but it really is what we do. And our job is to find every possible opportunity, be able to responsibly help you find the home that you wish to live in.
Carol, before you go on to David, if I could just add, that's really a great point, because there's a lot of self-employed people out there that have had a mortgage for years. They're great borrowers. They pay their mortgage on time, but with all the changes in the mortgage program and eliminating some of these things, they feel as though they're stuck and now they can't qualify. It's frustrating for a self-employed person because they'll say, well, you'll give a mortgage to a first-time home buyer with less than good credit. I've paid my mortgage on time for 20 years. All I want to do is get another mortgage and buy a different house. So this allows, it's a new and an option for people in that case.
That's a great point. Okay, so in other words, the message there is, if any of you out there have gotten discouraged over the last couple of years because of guidelines for self-employed, there could be, through this program, opportunities that you don't know exist. Great. Okay, so actually that's a perfect segue over to David. David actually does have a couple of examples of individuals that have been able to purchase a home that did not have the opportunity otherwise, and he's going to walk us through that tonight. You know, one thing I want to mention about David and all of our agents here at Jack Conway, you know, their job is not only to help you through the entire process of purchasing a home, but their job is also to keep their ear to the ground, to learn about different programs that are out there that might help you. And because of that, David was able to help these customers. So I'm really excited for you to hear about these two examples. David, can you walk us through your first example?
Yeah, and before I get into that, I just want to say, you know, as a realtor who works with buyers every single day, it is so exciting that self-employed folks now have this great tool to leverage their buying power. We've worked with several self-employed clients for a long time that were not able to purchase, who now are able to have that goal of home ownership has either already happened, or, you know, that they can see that in the near future. So the first client was looking to upsize their living situation and looking to purchase in the $900,000 to $1 million range. Their business was recently doing well and seeing growth. Their tax returns from the past 2 years actually didn't quite show a profit. And they normally wouldn't have been able to get qualified until till they filed their taxes this year. They would have had to wait because of the recent surge of income in their business. And because of the Smart Self program, Conway Financial Services was able to use their bank statements to qualify them.
All right, that's really cool. So let me just make sure that our listeners understand. Your customer can afford this house, right? They have the income to be able to purchase this home. They just didn't have the ability to document at this time. Is that correct?
Absolutely, yeah.
Okay, I think that's a really important point to make, because again, David, Kevin, all of us here at Conway want to make sure that people are purchasing a home that they can live in very comfortably. Kevin,
hey, Carol, I was just going to say, if I could add on that, because you know, if you think about it, if a borrower for the last 12 months today is really, their business has really taken off a little bit, we can use that bank statement program to qualify, where that income, if they're going to claim that much more and now show a greater profit on their taxes, it's not going to be available till next April at the earliest. So they'd have to wait before they start. And now they're potentially, you know, it's a better question for David, but they're missing a market, you know, when prices are potentially still going up. And, you know, it allows them to buy now and not have to wait.
That's a really great point. So David, staying with Kevin's point there for a moment, this provided this client and could provide other clients the opportunity to purchase now before the prices continue to rise. Are you still seeing prices rise in your area that you cover?
Yes, yeah, prices are still, it's still a very competitive market. And, you know, if properties are priced correctly, sellers are still finding themselves in multiple offer situations. So it's crucial that buyers write the strongest offer possible.
Okay, that's a great point. I love that you just said that. So first of all, I'm going to give you guys just a little bit update on where we are in the real estate world. As David just mentioned, prices are continuing to rise. We are not rising at the same rate as we were rising before. We actually just talked about this at a meeting earlier today here at Conway. Last month, our average prices went up about 7%, where they were going up between 20-25% there for a while. Not a sustainable number. I think you can all agree with that. If you're a seller, that's fabulous. For your buyers, that's a pretty tricky situation to be in. So David, to your point, for the buyer side, why do those offers need to be so strong? Like we're still got a kind of a competitive market out there, right?
Yeah, it's still competitive. It may be taking a little bit longer for sellers to accept an offer, but they're still finding themselves in multiple offers. So if a buyer really wants to be a player and really serious about getting their offer accepted, it's crucial for it to be as strong as possible. So really, the second example that I had is there was a client who kept getting denial after denial by other lenders because their tax returns didn't show enough income. But because of the new smart self-loan program, they were not only able to get qualified to be able to purchase, but they also were able to not have to sell their current property in order to purchase. So their offer did not contain a home sale contingency. Okay,
so tell us again, for those people that are walking their dogs, everyone heard David's dog out there. He completely understands. What do you mean by home sale contingency? Why is that important, that piece?
So in other words, their offer was written where they didn't have to sell their current home that they're in. So in a seller's eyes, it makes their offer stronger because they don't have to sell in order to buy.
Okay, and the Smart Sell program helped them with that.
Absolutely.
All right, that's awesome. Another question just came up in the chat, and this is perfect timing. This can be partly answered by David and partly by Kevin. The question is, can I use this loan for either a second home that I want to buy or an investment property? David, I don't know if your clients, I'm sorry, Kevin, they were buying this for their home, or were these investment?
These two examples were not investment, so okay. Maybe Kevin can speak to that.
Okay, Kevin?
Yeah, it's a great question, actually. Most people assume that it's only for owner-occupied purchases, but we actually can use the product on all three: owner-occupied properties, second homes, as well as investment properties. In addition, we also can do refinances, including cash-out refinances on all three types of properties.
All right, that's fabulous. We have seen such a change in the way people have behaved when it comes to purchasing homes over the last couple of years. The pandemic has really changed not only where we work, how we work, but how we spend our free time. And, Kevin, maybe you can comment briefly on how second homes have become a huge thing in our buyers' minds right now.
Sure. I mean, in a way, everything's changed, right? I mean, part of the people that are qualifying this mortgage are people that were going to an office every day, and then we had a pandemic and they realized, I don't want to go back to an office. So instead of taking that salary job, I'm going to work per diem for multiple different companies, and it allows me to work from home. They think, well, I can't get a mortgage now. I'm self-employed and I have 3 different 1099s, or I'm claiming just self-employed income. This is an option now where, we're 3 years into a pandemic, they can qualify for a mortgage that way again. So they're kind of shut out. But the same with the second home, you're seeing more people, working from home, and where they're at is more important. You have people that, their primary job is in Boston, but they can be in Florida for the winter months and still be working full time. So it has completely changed, how, in a way, the world operates, but certainly employers operate.
That's a great point. David, are you seeing that also with your clients? Their interest, what they're looking at for properties is a little bit different than it was maybe before the pandemic?
Yes, I mean, so many more people are working remotely now. So there's definitely that need to maybe leave the city and look at something bigger with a home office or more space for children and, you know, larger yards. So we're definitely seeing that shift in the market.
All right, great. And I think that's just a great reconnection back to our topic tonight, which is the self-employed individual. All of you out there that are consultants, or as we said, the plumbers and maybe hairdressers that you're doing it out of you have a chair in your basement. So there's a lot of different behavior, and if you don't believe you have the option to purchase maybe a larger home or some home in a different location, make the phone call. It's free. You can find out whether you're prepared. If you're not looking right away, you can get things in order as far as credit enhancement. So there's a lot of really great options here. So, you know, I want to thank Kevin and David. They provided us so much information and really good perspective in this product. I feel like we did what we had hoped to do, which was provide a real deep dive into a very important topic. Before we leave our audience tonight, could you both leave us with one thing that you would like people to remember? David, I'm going to start with you.
Yeah, absolutely. You know, it's really as simple as, you know, for someone who works with buyers all the time, it's really as simple as, you know, knowing that you have options, and pick up the phone and call your trusted advisor, your trusted real estate advisor. And it can't hurt to talk. And then, you know, the realtor is the one person who's going to be with you from the very beginning of the home buying process all the way to the closing table. Other people will kind of come and go in the process, but as a realtor, that's the one person who will guide you through the entire purchasing process and will be able to connect you with the appropriate loan officer to determine which is going to be the best product for you. So it's just so exciting to be able to have this Smart Self program as an option for the self-employed folks.
I love that. That's great. Those relationships we have with our clients are so important, and being the trusted advisor is something that we take very seriously. And so I really appreciate what you left us with, David. Thank you so much. I really appreciate you're sharing those two examples. Fabulous, wonderful to hear about people having opportunity that they didn't have before. And the fact that you thought of it is really great. And thank you for Kevin's team for helping us make that happen. So Kevin, leave us with what you would like the audience to remember about this topic.
Yeah, I don't think I could say it any better than David said about being that trusted advisor, and, you know, there are options available. I guess the biggest takeaway is, you know, it's a myth that you can't get a mortgage when you're self-employed. That's a big takeaway. There are options available, as David talked about a little bit, and I would encourage everyone to make that phone call, set up an appointment, talk about your options, and, you know, find that trusted advisor that you can run questions back and find out what is available for you.
That's awesome. Great. Thank you so much, Kevin. Thanks for sharing all that information about this product. It's a complicated product. It's complicated process. And that's why we wanted to give you a little bit of information so that it prompts you to have the confidence to be able to make that phone call. And hopefully we can walk you through the process. So thank you so much. So before I hand it over to Gillian to close us out tonight, I just want to thank you all for taking some time out of your very busy schedules. This has been really exciting to debut our first Conway conversation with all of you. And feel free to reach out and ask us questions after the event. Gillian will send you the link to be able to do so. And again, thank you so much for listening, and have a wonderful evening. Gillian?
Well, thank you so much, David, Kevin, and Carol. It's been a great conversation. In closing, again, you should be receiving an email afterwards where you can respond directly to me with any questions or topics you'd like to see. But also, obviously, you can visit us at jackconway.com and look at properties, reach out to agents, and or reach out at info@jackconway.com, which is our general email address. And just so you know, with hurricane season coming up, our next topic is going to be flood insurance, and we'll be doing that at 6 p.m. again, and that is going to be on October 18th.
Wonderful.
So thank you all for being here and good night.
Good night, everybody. Thank you.